Hi, everyone, and welcome to the Tamra Wade Show. I'm Tamra Wade, and I am excited to be here today with two very, very knowledgeable people in the real estate industry right now that, right now we're a little bit nervous, realtors, buyers, even sellers, and what do we need to do? So the key thing is right now is that we need to be listening to the people that understand what's going on in the industry, and we need to be listening to facts and working from there. So today, I'm excited to let everybody know that I've got Matt D. I'm not saying your last name because I never say it right. And you would die if you heard all the ways I've said it before. So he is Senior VP of the Builder Division with Southeast Mortgage. And then I have got Jason Smith, which I have no problem saying that last name. So he is the Assistant VP of, and he's of the Executive Mortgage Loan and you're an executive mortgage loan originator. You've got this long title, but there's a reason for it because he is number one. So what I wanted to do today is talk about different things that are going on with regards to mortgages and try to make sure everybody understands what the truths are versus all this other stuff that's out there. So Matt or Jason, take it away on, I guess my first thing is, do you need 20% down? Because we're hearing a lot of that right now.
You gonna take off, Matt?
Jason, you want to go?
All right, I'll go. All right. So a lot of, you're starting to see a lot of things out online with people saying that banks are going to, to where you're going to have 20% down. It's just a lot of people right now are just doing, basically having knee-jerk reactions to this whole market. So it's not true. Conventional wise, you can go all the way down to a 3% program. FHA still has 3.5%. We're still funding for VA and USDA, which are 100% loans as well. So it's definitely something that's not an issue as of right now. Not to say it couldn't come down the pipeline later on, but we are still moving forward with low down payments for our borrowers.
Awesome. Is there anything with regards to that right now? When people are getting prepared to buy a house right now, things that you can recommend that they can be doing or pulling together. Do you guys tell them? I guess I'm jumping around with questions, but one of the things, I guess, do you tell them, like you look at their scenario and you tell them what program they should be doing versus them trying to figure it out on their own?
Yeah, I mean, one of the big things, a lot of people come to us with a program kind of in mind. Maybe they've done some research on the internet, things like that, or maybe they've bought a home before. Some people come in that just are totally against FHA. And then some people come in that want to be FHA and they don't want to do conventional because they think that they have to have 20% down. And so a lot of times when we have that conversation with them and let them know that there's, low down payment, options for conventional, as a loan officer, I like to show them two different options, put them side by side. A lot of times the credit score is kind of, I would say, the determining factor. In our world, kind of 680 to 700 or lower is typically going to be an FHA client. 680 to 700 or higher typically falls in the conventional side. So we can usually make that determination on that because interest rates are heavily affected on conventional financing, and then mortgage insurance is heavily affected with lower scores. So typically, as a loan officer, when we see that, we'll flip them to an FHA because it's got a flat mortgage insurance premium. No matter if you had a 660 or an 800, you pay the same MI monthly. So I think it's best to, look at the scores, look at the loan to value to figure out what's going to be the best rate and mortgage insurance premium for the client.
Okay. What about like their credit score? So when their credit score is, it's kind of borderline to do maybe whatever's the best for them, what does Southeast do? What do they offer to people?
All right. One of the things that me and Matt, we're very well versed at doing, and a lot of, once you do a high volume, you figure out that a lot of your buyers are not always at the score they need to be for the program that they want to actually close in. So we have, credit analyzers that we run all of our files through, and we go through rapid rescores with a lot of clients. So on a new construction home, they may go under contract 4 months ago and have maybe a 650 score, but we can see the potential points on the rescore that they might be a 720 by doing these few little things that we can instruct them to do and then get a new score and close with a better interest rate and a lower mortgage insurance premium when it's time, when the home's ready.
I'd add on to that, Tamra, too, and I'm going to digress for a minute. There was an article that really got pressed all over Google. It was yesterday, and it picked up a head of steam today as well with a large national or international bank, which is making some sizable adjustments to both credit scores and down payments. And I've taken a lot of calls both last night and today that really put a head of steam behind this whole idea that you need to have 20% down and a score of 700 or higher. And, you know, again, that article just made a lot of people really nervous. And I want to reiterate what Jason just said a few minutes ago, which is that's just so not the case. I think you will see some of the larger lending institutions begin to get more and more conservative, especially some of the bank-based lenders.
Mm-hmm.
But at Southeast here, we're a non-bank lender. All we're doing is mortgages. That's it. So we're not opening checking and savings accounts. We're not managing investments. Mortgages are business. So we really have an appetite to help folks get into homes. And I want to make sure that that's definitely stressed as we're speaking here this afternoon.
That's awesome. Yeah, because a lot of people Google everything, or they see stuff on Google and then they roll with that. So good information on that. The next thing is, you know, right now, so many people are scared about their jobs. And what happens if I'm under contract, got my loan's in process, and I get furloughed? How does that affect their mortgage, like applying for a house or mortgage?
So that's a really great question. And we're starting to see that come up here a little bit. Actually, this is the first week that we're really seeing it occur with some more regularity. Basically, the guidance we have at this point is that as a lender, we're required to use our best discretion as to whether or not that buyer is going to continue to have the ability to repay the mortgage after we close. So instead of creating a one-size-fits-all policy, what we've decided to do here at Southeast is evaluate each borrower on their own individual file. So we're looking at everybody as a person instead of as a group, which I think is really, really commendable. And it's a testament to our flexibility and our eagerness to help people purchase. And ideally, just some general guidelines around that, as we would like, obviously, to see them having returned to work. The furloughs that we're seeing right now haven't really exceeded more than 30 days. So in a lot of cases, these are just temporary, and it's not permanently preventing anybody from closing. And then we want to make sure that we're not setting people up to fail. So we're going to re-review the file and make sure that once they are back to work, we're not closing them just to close them. We're setting them up for success. And I think that's also really, really important.
So if they get furloughed, they can't close until they go back to work?
That's right. They would need to return to work.
Okay.
And that aligns very closely with some current policies that already exist in the marketplace as it relates to things like temporary disability, those types of things. So it's not a stretch by any sense of the imagination that, you know, that would just be good, solid, consistent credit policy to apply that already exists.
Yeah, because we're getting that here and there. We're hearing people on the real estate side, like, you know, we get buyers that call and they say, I've just got laid off temporarily, or, you know, I'm scared I'm going to lose my job. And, you know, we're trying to hold them in and say, you know, we all don't have a crystal ball, but, you know, don't jump just to jump. I mean, people that are walking away from big deposits, and we're actually talking through it. So, you know, I think it's really important that, you know, when people are having that happen, they talk to their loan officer and they talk to their realtor and they make sure that they get the right information before making a decision like that.
I'll tell you, hey Tamra, before you go on to the next, I'll tell you one situation I ran into. I had a borrower that her company called her, and she's got a pretty high paying job, and they called her and said that they were going to furlough her, and we're about 30 days away from closing on this home build that she's been building for the past 5 months. And so she had a backup job that was kind of in her kind of offer plate, and so she took that job. It was pretty similar pay, and she had been at her company for a long time, and so she just basically told them, look, I've got to do this to maintain my approval for my home. So it worked out for this lady. We've already gotten a pay stub from her. She had to switch jobs, but she said first and foremost, she did not want to lose her house she's been building for 5 months.
Wow, that's been thinking through situations like that, and she was ahead of the game.
I mean, I'll give you another example. We had one come up, it was this morning actually, and this particular individual is in the travel business, and they're being furloughed for the month of May, but not closing until, ironically, the first week of June. So we evaluated the file today. We've already verified that it's a furlough and not a layoff, and we're going to go ahead and we're going to close out loan the beginning of June, business as usual. No sweat.
That's good. Let me ask you this. I know I wasn't going to bring this up, but I am going to now. So, everybody getting, it just got me thinking, we need to talk about it. So we got a lot of buyers right now that they've own a current home. They're probably getting ready to close soon, or they're doing new construction and their house is on the market. And they're getting these emails saying from their lenders and different people, you can defer your mortgage payment. My fear on that is that shows at some point, I know it, from what I understand, it's not going to affect their credit score, but I guess like when you look at certain your credit reports, it shows like your payments, and then what is it going to show, like blocks on your credit report that you didn't make payments in those months? Could it creep back up on them, you think, and cause them an issue trying to buy a house down the road?
So this is Jason's favorite topic, but I'm going to steal it from him. So the best piece of advice I could give to anybody right now is that if you have the ability to make your mortgage payment, make your mortgage payment. There's a lot of misinformation floating around the market right now on what forbearance and deferral mean. Forbearance should only be used, in my opinion, and talk to your mortgage servicer just to make sure that you've got a complete picture on what it means. But forbearance means that in most cases for 90 days, they're going to allow you to not make your mortgage payment. The part most people misunderstand is that come month 4, they're going to come to you looking for 4 mortgage payments, not the next mortgage payment. They're going to come looking for all 4. And as an industry professional, our fear is that a lot of these folks are setting themselves up for pre-foreclosure and foreclosure because they don't understand what forbearance really means. I mean, certainly these services are trying to help you out, but the details of this are very serious. And again, I would just stress, if you can make your payment, make your payment. If you need help, call your servicer. And that may or may not mean that forbearance is the right solution for you. It could be, but just make sure you've got good information. As far as deferment's concerned, that's a restructure of the loan. And in most cases that would follow guidelines associated with loan modification, which can also affect your ability to obtain a new mortgage. So just don't do anything without speaking to a highly professional, well-seasoned mortgage loan originator that ideally, quite frankly, went through the last cycle of this and has some experience dealing with it, and go from there.
We lost your volume. Matt, we lost your volume.
Oops, I'm sorry, I'm back.
Okay, that's okay. It's our new world. Okay.
It's our new world. Yeah.
Well, also it's car payments too, because a lot of people are their car payments. They're getting this stuff too, saying, hey, you can, defer a payment. You wouldn't recommend we do that either. Them, not we, them, or anybody do that either.
No, nothing that's reporting to your credit that could affect your ability to repay.
Okay. I guess I've got one more question at this point. So we're hearing all kinds of crazy things with FHA, and credit scores are ranging all over the place. So if you're a buyer looking to purchase a home, or you're evaluating mortgage companies right now, one of the big things is that you have some saying, hey, I can do this credit score of 580. Some are saying it's got to be a 680, and then there's all this in between and all these different things. It's very confusing for a buyer. It's very confusing even for us realtors, because we're trying to give guidance and help people out. So, I guess like right now, if you don't qualify FHA, or if things start to kind of go awry, what would you say are people's options with regards to FHA at this point?
Well, I mean, the big thing is a lot of the credit score that we got hit with the increases on that, we decided as a company to do is on the government stuff. So we're still getting approvals. Like I triggered one 2 days ago. He was a 626. I got an approval conventional. So conventional still will allow, lower scores than FHA, which is in normal times, it's opposite. We can usually go lower FHA than we can conventional, but right now it's still working. So I think as a company, we decided to go the 660 route. Some banks are going 680, some banks are going 640. Everybody's, it's not an FHA guideline yet. So it's like each individual institution can decide as a company what's going to work best for them. And we have found, through trial and error, that our people between 640 and 660 on government loans with DTIs over 50% have a high default. And so as a company, we said, let's try to weed through this during these hard times and work with our borrowers that are 660 or higher. If someone is a little bit lower, a lot of times it doesn't take much on the rescore, part. If they're a 640 or 650 and they're close to, qualifying FHA, it usually doesn't take a lot of money on the borrower's file to get it positioned to a 660. The other side of it right now, if they're closing in the next 30 to 60 days, they may want to just do conventional anyway. So the little bit of a lower score, but beneath that 660 might still be fine to go ahead and close conventional and still have a great rate.
Mm-hmm. That makes sense.
I'm going to tack on to that here too. I mean, one thing I don't think that consumers do enough of nowadays is actually they may Google the loan officer and get a little background on who that person is. And they may generally know something about the company that's originating the loan. But I'm going to go ahead and just plug our company here for a second, and especially our leadership team. They really have done a very nice job forecasting how we need to be positioned as we begin to work through this market. And part of the changes we made corporately are to ensure that we're in business for another 28 years. I mean, Southeast has been under the same executive leadership, the same name, and has survived now. This is going on its third recession, and that's no accident. So you really just want to make sure you're working with a company that gets it. And I would say right now that we're one of the best in the business as far as getting it.
I would agree, because being in being in my position, when I have multiple builders, multiple communities, hundreds of homes under contract, and you guys have a vast majority of it, I'd like that you're proactive. You got with us, me being a realtor and other realtors on my team gave us the insight so that we didn't get the big surprises right before closing that, oh, well, you know what? Your buyer's not going to close. We were hoping that the rate was going to come up, or we were hoping that the market was going to get better, and we're hoping this was going to loosen up. You're just being straightforward and saying, here's where it is. And I think that's critical. In fact, I've utilized that talking to several of our other preferred lenders, telling them, I need this information. Don't just tell me that their score is here. They can't tell me all the details of the loan, but they, don't just tell me here's where they're at and, we're going to go ahead and send them on to another lender. And then see if it works out there. I would prefer to know, hey, this is kind of shaky. Let's work together. Let's help this buyer. Let's move them forward. And if it's not going to work, then let's start having that conversation versus them getting to where they have their moving van packed and their kids are excited to get into their new rooms. And then all of a sudden it's like, I'm sorry, guys, we couldn't control what happened and we were hoping it was going to get better, So Southeast is a great company. I've had amazing experience. I've been doing this 21 years and the only company so far that I feel like is just really goes the extra mile for a lot of things. And no offense to my other preferred lenders if they watch this, but Southeast is the one that we deal with a lot and I have a lot to say. So it's just the one that I get to communicate with most of the time.
Yeah, and just kind of add to that, Tamra. One of the things, because I'm getting a lot of, I've got a lot of friends that are in this business that are on the loan, they're MLOs for other companies, and we all kind of talk, and they're like, hey, my company's requiring this, kind of comparing. And so we've got these few companies here in Atlanta that have not increased their score guidelines throughout their company, and they're kind of walking around beating themselves on the chest, kind of like, hey, we're still doing 600s. But what a lot of people don't realize, that's the company that's going to get stuck, with those loans and eventually can't sell them on the secondary market because, the investor-wise, they're all the same investors are buying from all the mortgage companies. So there's a reason why that we had to up ours, because we want our loans to be able to be purchased on the secondary market so that we can re-lend our money. So if not, those companies, once they're out of money, no one's buying their loans from them at that point, they're not going to have anything to lend out anymore. And that's when they go bankrupt.
Well, and the key thing is you guys are educating your clients. So you're educating people on what to do. How is it going to work? And yeah, we don't need another 2008 financial crisis. And I feel like Southeast is not one that would ever put us into that part of that whole piece of it, because they're like, hey, here, these people work and this is how it can work. And then if they don't, then hey, there's another time to buy a house. It's the one thing you don't want to do as a buyer is be house poor, or have where you really shouldn't be buying it. And I believe Southeast is a company that's going to be straight up and say, hey, you know what, maybe now it's not right, but let's see how things play out. And, let's see what it looks like in 2021, no harm, no foul. Let's just try to work through this together and figure out what's the best thing. And of course we all want to sell houses, but on the other hand, it matters, what's, our buyers are, what their situations are. And we just don't want to sell a house to just anybody who can just, like years ago, they used to say breathe on a mirror or whatever it is. I never say
fog a mirror.
Yeah, fog a mirror. We don't want that. We want people that are happy, that are in their homes and they're not strapped and freaking out. We want to make sure they get good, good service, good attention, good rates, and they want to purchase another house and go back to Southeast for their next house. We don't want people to say that, anything negative about either me. So I think there's a lot that people can get from this, and I hope that they enjoyed this video, and we'll come up with some more, but these were some high level topics that have been coming up over the last couple days that we wanted to get out to you. So thank you, Matt and Jason, for your time. I appreciate it.
Absolutely.
Thanks for allowing us to join you.
It'll be interesting. We have to get back to the real world and dress up again, right? So go dogs, since y'all have the dogs on. So that's real cool. I don't, but I've got a son who's sitting in Athens, he's in his apartment waiting to get back to the real world. So he's like hanging out with all his buds.
Hopefully soon.
Yeah, but it's hard. So, this is hard for everybody, but if we can help as a group and educate, that's what we need to be doing. So thank you. Yep. I appreciate your time.
All right. Thank you, guys.
Bye.
Thank you. Bye-bye.